So you've packed your bags, booked your one-way ticket to Dubai, and you're ready to say goodbye to UK tax forever. There's just one problem. HMRC might still be coming with you. Welcome back to Pension and Benefits Guide, the channel where we break down confusing tax and pension rules into plain, simple English so you actually know where you stand. If you've ever thought about moving abroad, today's video is one you really can't afford to skip. Here's the myth that just won't die: I'm moving abroad, so HMRC can't touch me anymore. Every time there's a story about someone jetting off to Dubai, the comments fill up with people saying that's it, they'll never pay UK tax again. But moving abroad doesn't automatically mean you've left the UK tax system. HMRC doesn't wave goodbye at passport control and wish you the best. Instead, they look at your tax resident status. Don't switch off because of the fancy name. It just means HMRC asking one simple question: have you genuinely left the UK, or have you just changed where you sleep most nights? To work that out, they use the Statutory Residence Test, or SRT. It's been around since April 2013, but plenty of people have still never heard of it. Most people know the 183-day rule. Spend 183 days or more in the UK during a tax year, and you'll generally be treated as a UK resident. But staying under 183 days does not automatically mean you're in the clear. HMRC also looks at your ongoing ties. Do you still have a home here? Is your husband, wife, or family still living here? Are you still running a UK business or working back in Britain regularly? Have you spent more than 90 days in the UK in either of the last 2 tax years? And overall, does it still feel like the UK is really where you're based? It's a bit like moving out but still keeping your bedroom exactly as it was, popping back every weekend, and letting your mum do your washing. Eventually, people question whether you've actually moved. HMRC thinks the same way. The more ties you keep, the fewer days you can spend here before you're pulled back into UK residency. And if that happens, you could remain liable for tax on your worldwide income, including overseas investments, foreign pensions, and rental income from abroad. Double taxation agreements can often stop you being taxed twice, but the key is understanding your position before you move, not after HMRC starts asking questions. Before we go further, if you're finding this useful, do me a favor and hit that subscribe button. We put out videos like this every week. And drop a comment below, I read every single one. Now here's where it gets trickier. Say you've genuinely left the UK, become non-resident, and even passed the statutory residence test. Job done, right? Not quite. There's another rule that catches people off guard: the temporary non-resident rules. The idea is straightforward. HMRC doesn't want someone leaving for a couple of years, selling a valuable asset tax efficiently, and then quietly moving back like nothing happened. These rules can apply if you were previously UK resident, become non-resident, and then return within a relatively short period, often 5 years or less, depending on the income or gain involved. Picture someone who builds a successful business, moves overseas, sells the business while abroad, then 3 years later moves back. HMRC might take a fresh look at what happened while they were away. That doesn't automatically mean extra tax is due, but timing matters, and understanding the rules before big financial decisions makes a real difference. But the most important part is this: even if you avoid the temporary non-resident rules, HMRC still isn't finished with you, especially if you own property back in the UK. If you still own property here, HMRC is usually still interested in it, whether it's a buy-to-let, a holiday home, your old family house now rented out, or a whole portfolio. That rental income can still be taxable in the UK. Imagine you've retired to Portugal but kept your flat in London, bringing in £2,000 a month in rent. It's easy to think that's now Portuguese income. It isn't. It's still UK property income, and HMRC still wants to know about it. There's even a non-resident landlord scheme designed to make sure this income is properly reported and taxed. Letting agents, or sometimes tenants, might have to deduct basic rate tax before rent reaches you, though in many cases you can apply to receive rent without tax deducted upfront. Keeping a UK property also affects things if you sell it. Here's a belief most of us hold: you never pay capital gains tax when you sell your own home. Usually true, usually being the key word. If it's genuinely been your main residence, you can normally claim private residence relief. But moving abroad can change the picture, because HMRC asks how much of the time you owned it was it actually your main residence. Imagine you move to Spain, buy a home there, but keep your old house in Manchester just in case. A couple of years later you sell it. The question is whether the property still qualifies for that relief for the whole period you owned it. There is some breathing room. The final 9 months of ownership generally still qualify, even after you've moved out. But that's breathing space, not a free pass to leave a property empty for years and assume the whole gain stays tax-free. There's another common mistake too: people move abroad, rent out their old home, and assume old letting relief rules still apply. Those changed significantly back in 2020, and it's now only available in much more limited circumstances, such as sharing the property with a tenant. And one more thing: if you're non-UK resident and sell a UK property, you may need to report the sale to HMRC within 60 days and pay any capital gains tax due in that window, a deadline many people discover too late. If you're a business owner, there's something else to consider. Many assume their limited company simply moves abroad with them. It doesn't work that way. You and your company are separate legal entities, and HMRC, along with your new country's tax authorities, will want to know where the company is actually managed, where decisions are made, contracts signed, and the business run day to day. This is called central management and control. There's also the idea of permanent establishment. Imagine running your UK company from a home office in France, speaking to customers, signing contracts, making decisions there. French authorities might reasonably ask if the business is actually being run from there. Suddenly you could be dealing with UK corporation tax, your personal tax abroad, local business taxes, and double taxation rules all at once. And finally, pensions. This is where the real impact becomes clear for a lot of people. Living overseas doesn't automatically mean your UK pension falls outside UK tax rules. What happens depends on the type of pension, which country you're now resident in, and whether a double taxation agreement exists between that country and the UK. Some agreements give the UK taxing rights, some give it to your new country, and some depend on the pension type. Don't assume that because someone in Spain or Dubai told you how it works for them, the same applies to you. So what's the real takeaway? Leaving the UK and leaving the UK tax system aren't necessarily the same thing. That doesn't mean you shouldn't move, it just means understanding the rules before you book that flight, rather than untangling everything afterwards. Let me know in the comments: are you planning a move abroad, or do you know someone caught out by one of these rules? And if you're specifically thinking about Dubai, I've done a full video going into much more detail, links right here, go check it out next. Thanks for watching, and I'll see you in the next one.